All right, good morning, everybody. We got Tom Basso back with us for the CRE Spotlight. We're super excited. Tom Basso's a famous trader, author, wine connoisseur. I hear a gourmet cook. I'd like to taste it someday. Uh, Wonderful husband and father, now grandfather. So congratulations.
Yeah, that's been fun.
All right. Well, thank you so much, Tom. You just published your book, The All-Weather Trader. So we just wanted to ask you just briefly the genesis of why you wrote The All-Weather Trader. You've written a few books prior.
Yeah, and writing books, people ought to know that, you get paid less than minimum wage for doing that. It's not something you do to make a bunch of money unless you're like Stephen King or something. And I certainly am not. And this book would have a limited appeal to people who are traders trying to improve themselves, try to figure out how to smooth out their track records, how to bring in kind of new features and tricks, how to deal with the mental side of trading and all that. So the reason I wrote it came out of what happens to me, running enjoytheride.world and being fairly active on social media on certain days at least. And I found that some of the same questions that people ask me either in direct messaging or even publicly as a post or a comment on something I put out there seemed to fall in certain categories. They were about position sizing, or they're about the mental side of trading, or are they about what indicators there are, what indicators do I use and how do I use them, and what are my parameters, and how do I hedge? And so I started thinking, if I took all these things and threw it into an outline, it would basically write itself. I mean, all I'd have to do is take the outline and okay, this is this chapter. Let's just fill in the chapter. And so I started writing it, and it was just so easy to write it. And it sort of ended up becoming what I call an autobiography of my trading life a little bit. It starts from the things I learned back as a paper boy buying mutual funds at Fidelity way back when I was 12 years old, which is a long time ago now. And it kind of got into some of the early discoveries I made and how I struggled with that, and how I overcame it. And then it kind of got into I'm running Trendstat, and where you've got clients all over the world, and I'm managing $600 million. And then you retire, or I retire, and for 20 years now, and I now have no regulations on me. I lapsed all my registrations. I'm not a registered investment advisor anymore, not a registered commodity trading advisor anymore. I'm not on the board of the National Futures Association like I used to be. So it sort of took the bridle off, and I could just really analyze mathematically and try to be introspective with myself of what is it I really want to do, with my investments. And it kind of shows with some ideas how I have smoothed out my track record. I have filled the pothole, which is one whole chapter in the book, potholes, some of them at least. And I thought, this is a great sort of legacy to leave the industry, of how to approach the problem of evolution with your trading strategy, and what does it mean to be a multiple systems trader, and how about the mental side of all trading aspects, no matter whether you are are doing it every day in front of a screen, or if you're totally automated, there's still mental issues involved in trading. And I thought this is a very logical, very different book, because it focuses a little bit more on my progression and how I got from way back being a paper boy, knowing nothing about what I'm doing, to being very active and being interviewed all the time and having to manage my own portfolio. So that's kind of the thinking I had. And once I sat down and started writing it, it just flowed. It was easy. Hopefully it's very easy to read. I tried to stick to like eighth grade grammar chucker. Tried not to use very large words so everybody could understand it. It's very inexpensive. So there's a lot of great stuff in a very inexpensive book. And not surprisingly, it's become a bestseller in 4 categories on Amazon.
On my copy right
There it
here
is.
that I
Yeah.
read. Yes, thank you. It's a fun book, and one plug I would make that when I was reading it, it really did sound like you were talking to me because it's exactly the same Tom right in the book as, you know, over Substack or on LinkedIn or, you know, over a Zoom meetup. So it's pretty cool. How did
I
you
my
get,
the Substack pieces that I write when I am in the mood, uh, I uh, I intentionally write very easy and flowing, and it's like I'm talking to you. So I use that same, and those are I'm getting 3,000 reads on those things every time I put one out. So what I tried to do is to use the same style of writing in the book. So everybody that's reported back to me seems to love the style and the easy reading, and it just flows. So yeah, I think I achieved my
oh,
objective.
very much. Congratulations. How did you get the nickname Mr. Serenity?
Uh, that story involving Jack Schwager,
Oh,
he uh, he decided to do New Market Wizards because Market Wizards was such a bestseller. And so he went out and he started identifying sort of the next generation of traders behind the Larry Heights and the Michael Marcus and some of the original Commodity Corp guys and Richard Dennis and all those. And he got into the next tier, and he attended a THARP conference that I was speaking at. And because he was sort of a rock star and I was sort of a rock star, every time there'd be a break in this seminar, I would, you know, be out there in the audience and there'd be a group of 6, 7, 8 people around me, and there'd be 6 or 7, 8 people around him.
oh,
And, you know, peppering us with questions during the break. And we're kind of both thinking to ourselves, you know, we got to go to the bathroom here sometime. And so what ended up happening is by Sunday morning, he comes over to me and he says, Tom, I've been listening to some of the answers you give to questions, and they're so logical. And the people that are asking them are so appreciative of your answer. And I don't know if you know it, but I'm going to do another book called New Market Wizards. And I've interviewed a lot of people, but there's always room for a few more interviews, and we'll edit it down to the ones that we decide my publisher wants to put in the book. Would you mind me interviewing you for this book? And I said, sure, no problem. He says, how about lunch? I said, okay, I've got some time at lunch, but I got to be back by 1 o'clock. So we went down the street to a
oh.
little Korean restaurant, and we had a great interview once we got the recorder started and everything up and running. The problem is he just was having so much fun, and I was having so much fun in the interview that he had so much more he wanted to ask me. And I'm looking at the watch and thinking, I got to be back by 1, and it's going to take us like 5 minutes to get down the road to the hotel that we're at. Um, why don't you just give me a call when you can? I'll be back in Phoenix. You'll be in New York, and you can hit the record button and we'll just keep going. We don't have to limit ourselves to anything. And then you can edit out whatever you want. He said, you do that? I said, sure, why not? You know, no problem. So he did that. And then he sends me this FedEx draft. I read it at lunch. I call him up. I tell him, Jack, if you have your copy in front of you, I've got a comment for you. He said, okay. And I hear ruffling of papers. And now go to page 8, down in the third paragraph, you misspelled the word whatever. He said, okay, what's next? I said, that's it. He said, that's it. And the big pregnant pause. He doesn't say anything. And he said, you've read the entire chapter and you're okay with everything else? And I said, yeah, you pretty much captured what we talked about. In some cases, you touched up the wording a little bit to make it even more effective for somebody reading an interview, as opposed to you and I just talking and, you know, getting rid of all the ahs and the
Mm.
different things that happen when you do an interview. And he said, so, and then he paused again. Are you okay with me calling you Mr. Serenity? Because that's what he put as the subtitle. And I said, Jack, it's your book. You can call me anything you want. And he proceeded to say, Tom, I got to say, I don't know if the publisher will put your chapter in there. It was the easiest chapter I've ever written. It was the most interesting to me. And here, I've had traders just shut me down, and I get done with the interview. I do all this work to get it up and running, and they veto it. They won't let me publish it. And you're okay with me publishing it exactly as I wrote it, except for a misspelled word. And then you're okay with the nickname and everything else. This is so interesting. And I guess what he saw me as being so relaxed towards the whole process of trading and considering it a process as opposed to sitting there in front of a screen like a lot of traders, the stereotypical
Yeah.
traders do, and get all stressed out and, oh my gosh, gold's making a big move today, I got to get on that, or oh, it's turning around, I got to get out of it. And they're all, they're addicted to drugs and alcohol, and they're chain smoking and everything, in poor health, and they're going to get burned out in 10 years or less. And here I am, 71, still doing it and loving it and having a good time. So that's kind of where the name came from.
It's a great name. For when I one time in a LinkedIn post spelled it wrong and had it serendipity, which is a different connotation all entirely. I still get teased about that by Tony, our mutual friend.
Yeah.
In the book you touched on, there was a chapter where you talked about the strangest ideas the clients have come up with. That was the client that wanted you to not have any more long positions and only do futures. Um, you know, Dealing with clients, I'm sure over the years, and even dealing with traders or not stock market, familiar people. What is one, just if you have one more funny story about dealing with a client that had an unreasonable expectation?
Well, with the just wanted to be in futures and not stocks.
Yeah, is there another
Yeah,
one that was kind of funny or?
that was an extremely bizarre and, looking back, funny, but at the time it cost my company a lot of fees. This was a multi-million-dollar pension plan, and they had the ability to do hedging in the legal documents. So we concocted this way of doing a long-only stock portfolio. And then at appropriate times, when the trend shifted to down, we would put on a futures hedge against their long stock exposure, taking them essentially down to next to nothing in exposure, and then waiting until the next up move, pull the hedge off and let the stocks appreciate. And at the time I did the presentation, and you have to know that these guys were all PhD physicists. And I won't tell you the name of the company and I won't tell you what their product was, but they were cutting edge physicists, brilliant people on this committee. And so we all agreed and off we went. And along comes the crash of 1987, October 19th, and never forget it. And the stocks are down something like, I don't know, 23% in one day on the Dow. And our stock portfolio for them was down about 21, 22%, not surprising at all. The hedge, sorry, apologize on that. I got a landscaper calling me. I'll get to him later. The hedge actually made a fraction of a percent more than we lost on the stock portfolio. So get this, the stock market's down 23% roughly. And we actually make money tiny bit that day, thanks to our futures hedge. I go out a month later and think I'm just going to be a hero with these guys for saving all this potential risk that they had in their portfolio. Instead, they're suggesting to me that we get out of the stock portfolio and just trade futures, because during the down market, we made a bunch of money in the futures and we lost our, 23% or something in stocks. And I tried to get them to understand that those are tied together. The reason I did that, I was unable to convince them, believe it or not, with all that intellect in the room. They basically said, we're closing down the stock account. And a month later, I talked to my employees and all that. This was a several $1 million account. And at the time, that was pretty significant. I talked to the broker involved with it and everything. And I said, we cannot just trade the downside only of futures for these guys. They have no idea what they're doing. There's a ton of risk there. We're going to take losses on future trades along the way. They won't understand those. It looks dangerous from the standpoint of being a trustee for a pension plan. I just don't think it's a wise idea. So we fired them.
Wow.
and walked away from a multi-million-dollar portfolio. And so that was kind of not real funny at the time, but looking back, how humorous and absolutely
Looking back.
insane.
Yeah.
Yeah, it's been a long career. I've been doing this 50 years now, and I've seen all sorts of things.
Yeah. One of the most common questions I get is, if the markets are efficient, why would you trade or why would you hire, Standpoint Research or you? And I often have to tell people, well, if markets were efficient, Tom Basso wouldn't exist. Or they try to tell me, oh, Tom's an outlier. What would you advise me when I deal with people that seem skeptical of, well, why don't I just buy the index fund and give up?
Right. I think in those folks that are into academia and they use the word efficient market and efficient, curve, all that talk makes the presumption of looking at, say, 100 years of data and saying the stock market averages whatever 9% per year on average. Well, that's all great and fine, and that's even true. It's mathematically correct, but you're dealing with human beings. And one of the reasons why I put a bunch of mental side or mental psyche of trading, the trader's psyche section of the book, is to try to cover the fact that investors and traders, because of their mental processes, are not efficient. They do not accept the fact that you can make 40% one year and lose 20% the next. When the 20% rolls along, just like those brilliant guys, the physicists that we ended up sideways with, they couldn't understand how well designed that was to help protect them. And yet they were going to put themselves back into psyche problems and mental problems down the road by redesigning what I was doing for them already. And so the efficient market does not address at all. It's just a pure mathematical concept, and it doesn't address the very real control that an investment client has over the money manager, because they always have the right to fire you. And that's like a big club over your head all the time. So the money manager not only has to deal with his own psyche with respect to the investments and the markets, they also have to deal with the pressure that they get from the client, who has the club over his head and says, if you don't do well, or if you lose too much money, or if my track record's not smooth enough, or you can't get out of this drawdown fast enough, I'm firing you. And that is where the whole investing scheme breaks off from efficient market and all that, and into the morass of the real world. And I think that's where things like the all-weather trader, things like Trendstack Capital back in the old days. I'm chairman of Standpoint Funds now. Eric is doing a great job there as an investment officer, keeping the track record smooth, keeping the risk away, trying to deal with that client psyche in a positive way. And I think that's the difference between the efficient market and the real world. And the efficient market is just not the way most people think.
Yeah, that's wonderful. That actually goes into one of my favorite chapters in the book is the most subtle. Most people say, Andy, it's the most obvious, but it's not, because I meet a lot of people that you're going to be surprised, Tom, but the drawdowns and recoveries are not symmetrical chapter. Um,
Okay.
Usually when I ask a person, and I just try to make it easy and to say, if your manager loses 50%, how much money do you have to make to get back? And the amount of times people emotionally off the cuff say 50. And these are people, that are not dumb or uneducated. And I have to say, no, it's actually 100. And just a couple seconds of walking them through the math, they're like, oh yeah, I get it. And I said,
Yeah.
now do you understand why, the hedge fund that I'm part of, why we focus so much on downside risk mitigation, even more than we spend on upside? Because if if your drawdowns get too big, it really puts you in that emotional hole. Now it goes beyond numbers, it's emotionally. If I'm down X%, I have to make up this even bigger percent. And do
Yeah.
I now take on risks that I wouldn't normally take? Am I rushing through decisions? Am I letting emotions screw up all my trading? I was wondering if you could just comment on that, because that's actually one of my favorite chapters in the book, and I'm sure it's probably the chapter a lot of people are like kind of whipping through fast because it seems obvious.
Yeah, let's get to the good stuff. Like,
Yeah.
yeah, the drawdown thing is twofold too. Over 50 years of trading and 28 with clients, I'd have to say not only the severity of the drawdown, but the length of the drawdown. How long you stay in that drawdown also gets to sandpaper on the nerves for the client. They come on, we're in this drawdown. When are we going to make new highs again? And it looks like you're just kind of languishing, going sideways, and you haven't come out of it. You aren't getting any worse necessarily, and it's not that big of a drawdown, but you just aren't making money. And there's these other strategies over here that are making money. How come you aren't? And yeah, the whole money. I don't miss the money management industry. I tell you what, I put a smile on my face about 20 years ago, and it's been there ever since. It's a whole lot easier to manage my own money.
Okay. One of the comments one of the questions we got was the person was surprised, wanted to know why. Um, for cryptos, when you're using cryptos as an asset class, why you use futures and not an ETF?
Yeah, that's pretty easy. First of all, I've been trading futures for about 45 of my 50 years in the business. And so I'm very familiar with all the different, the exchanges backing up the futures contract and giving you some financial protection, which in many cases, especially given some of the bankruptcies of some of the crypto dealers that have happened over time, uh, I like to have that protection of the exchange behind it. And secondly, although some dealers have allowed for short selling or taking downside positions in a currency, you'd have to borrow somehow and short it and all that with the actual crypto, or do some kind of a synthetic of some sort, which is just
But
fraught with problems to the point where a firm can go bankrupt if they don't know what they're doing. If I'm in futures, I can just take the negative side of the contract. Somebody can go long, I can go short. I'm not paying any interest to do that. I'm not borrowing anything. It's just a futures contract. So it allows me to take a negative position in cryptos like I am right now, where cryptos have been on the downside for the last 4 or 5, 6 weeks, whatever. And I can enjoy that ride to the downside. And eventually it'll give me an up signal. I'll take it off and go long, but it's just so much more easy to deal with it. And in the case of ether futures, they are so micro ether. They're so small. With a very small account, you can afford one or two or three of those. It breaks it down into very small amounts for the smaller trader. So I think it's a natural place to start your search. And then once every 3 months, or no, once every month in the case of cryptos, you would roll it to the next contract. So right now, September is coming up as going to expire. So I roll it to October. No big deal. Sell one, buy the other. Easy to do. So I find it just easier and with a lot more protection.
oh, okay. Well, that'll help answer my friend who had that question. He's kind of a crypto enthusiast, so he was curious about that.
I
Uh,
guess there's one other thing I should point out to your
oh,
friend that if he's a United States citizen, the taxes and the records you have to keep on actual crypto trades is very different from just going through a futures broker, trading the futures, and it'll all come summarized in your 1099 and you don't have to worry about anything. And the tax treatment will be 60% long-term gains, 40% short-term gains, which is an attractive tax treatment versus say not just cryptos would be fully taxable short-term
I
gains.
didn't know that.
So you'd end up with a slightly better tax structure even. So,
I better send him the video when we're done.
okay.
One fun question we had, just because it's the most hot topic on the market right now, is are you using machine learning or artificial intelligence to identify trends?
Uh, the way I look at all price movement in markets would be that there's noise, That's just normal people buying and selling, buying and selling, buying and selling. And if you just uh, put a 1 minute bar on your screen and watch it for about an hour, you will see noise to a large extent, many, many days. So it'll go up a little bit, it'll go back down a little bit. That's normal market movement, and that's just getting buyers and sellers to transact business to each other. The trends are when economic forces or investor sentiment or a company's fundamentals or whatever the reason du jour would be, it causes the prices to go way beyond noise and they start going in one direction. That would be a trend. So the way I look at all price movement is I've got to separate the noise out and ignore it and take action when a trend changes. So I like indicators that sort of bracket the top and bottom of a noise band of normal market noise as things like Keltner bands, Bollinger bands, Donchian bands, those types of like price channels, top and bottom. Through the top is an uptrend, through the bottom is a downtrend. Take your action and enjoy the ride. There's nothing that you need to be doing inside that noise. That's just a whole bunch of people, I don't know. I mean, if you're in mutual fund, somebody redeems, you gotta sell a position to pay off the person to get him okay at the end of the day. So you've got to sell. You may not want to sell, but you have to because he's redeeming because he's going to go buy a car.
Yeah.
All right. Well, that's normal noise. I don't want to take action on something like that. So that's why I do it. So AI and machine learning, let's go backwards and discuss that a little bit. AI, everybody should realize, is named artificial intelligence. I think that is a great marketing term for AI, but there's no intelligence involved and it's not artificial. What our AI really is, and I like to keep reminding myself of this, no matter how intelligent the answer, how sophisticated your question to the AI platform, you are doing an extremely sophisticated, extremely fast, and extremely responsive Google search from the old days. To me, a Google search back in the old days, if we think way back to when dinosaurs roamed the earth in the internet, you put in a word, it would go out and look at the keywords associated with various websites and so on, and it would return a list of citations that might have something to do with your query. What is AI? Same exact thing, except now I can give it a short paragraph with a question, and the AI platform is going to come back with maybe up to 5 pages if I request it of a really brilliant sound.
Oh,
It's very
oh darn, you froze up for a
where
second. Uh,
it gives you the answer in English. You could somebody's do that grammar and it's punctuated and it has the capitalized in the right place and everything else. So, the problem you got is it's not really artificial intelligence. It is an extremely sophisticated, extremely fancy Google search.
oh,
And have all the biases of that Google search. And the AI has got biases because all that programming is written by individuals. Individuals have biases. So you have to constantly be looking critically at what comes back out of AI and asking yourself, does this make sense? Where did they pull this from? You might want to even cross-check your own references against what the AI is saying. Do not use it or misuse it, I would say, to have it decide which way the market's going next or something like that. Yet you would never do that with a Google search, and you shouldn't do it with AI.
makes sense. What is the process for you that goes in your mind before you would pick a new asset class to add to the all other portfolio?
Well, the first one is preservation of capital for starters. That's a very big one, and when I went into cryptos, I went into the futures on cryptos. The second thing is what kind of movement and liquidity would there be in that asset? One of the reasons, I mean, I own two homes, and we did own some rental real estate back a few years ago, but when the prices in Arizona went insane a couple of years ago, we unloaded every last rental unit we owned and went with more of the liquid markets, which I handle. The reason is if you got into difficult times and you were in just real estate, I think you run the risk of having potential liquidity problems, and you can't easily modify your risk. I mean, you could probably do some things if you have variable rate loans. You could hedge the bond market, for instance, or something. So there would be few things you could do to hopefully prevent a debacle in your investing, but you wouldn't be able to just pick up the phone or go on a trading platform and say, I'm going to sell that apartment complex over there.
Okay.
That takes some work. Months go by. You got to wait for the closing. Hell, 6 months, 12 months could be in the offing. So that's not allowing you as a investor to easily modify your risk structure. And so I definitely look at liquidity and how easy it is, how much volume is there. Am I too large for that market, or I'm just a little nobody and I can get in and out easily and modify my risk structure. And that, I think, keeps me more flexibly positioned for what the world might throw at me, because I have no idea what's coming next. I just have to react as best I can and stay on the right side of some of the trends and stay out of the trouble.
Oh,
So
okay. All right. I got a very specific question. It says, rather than using a stop loss order, why not just purchase an in the money option with the strike price equal to your stop loss level and the number of contracts equivalent to the number of shares you'd buy in cash?
that would be because to do that would require you putting capital to work, tying that up in a position that's going to be expired eventually, has time premium associated with it. And over time, if you look at the cost of doing that, you'll actually end up costing yourself, I believe, more than you would if you just put a stop loss in, which many times doesn't get hit. And so you don't do any trade and you let your longs just continue to go. So feel free to run that study, and I'd be happy to talk to anybody about it. And if someone can show me where it's a more effective way to go, then I'd be happy to switch what I do. But I really have not found that in doing any kind of simple calculation. It seems to me the options end up costing you more on the time premiums, particularly in times when the market's they're just very exciting. Then that excitement premium gets built in there. The time premium gets, you're paying a heck of a lot for that protection, and you lose those premiums. Even if it protects your portfolio, you're losing that. Now, that being said, doing the hedging the way I do it also costs me money over time. I just think it costs me less. It's a little bit less expensive insurance. That's all. And if there's a better way to do it, I'd be happy to hear about it.
Okay, well, sure he's gonna love that answer. Looking back over the many years you've been doing your strategy and building it into what it is today, what was the single most impactful iteration that you made to your strategy, the best change?
The most impactful, according to studies I've done, would have been my position sizing, which is why I wrote the book on position sizing.
That's oh
It
wow,
turns
that's
out,
the next question on my list. Jeez.
it turns out, if you do the studies enough, and certainly Trendstat, we had some great computer guys and one woman, so I lump her in with the guys. And we did some great studies on all sorts of different topics that I think really helped solidify a lot of my thinking. And when you look at the effect on your results of getting position sizing wrong versus and this is logical. Let's take as an example my three favorite indicators, which would be Bollinger, Keltner, and Donchian. If we take those three and we separately apply one of those indicators to a set of a portfolio over 10 years, 20 markets and futures, or whatever you want to do, and you run through all of the different buys and sells, and you just do one contract, something like that. And then you do the same thing with Keltner and the same thing with Bollinger, you'll find that the difference between those will be very minimal. And why would that be? It's that whenever you have a very long trend, that's where all your money gets made. The little herky-jerky false whipsaws and all that nonsense that you do a lot of work for as a trader and get nowhere are all to set yourself up to catch that one that just goes nuts. And that's where all the money's made. Well, it turns out that if, say, the Keltner gave you a signal today and the Bollinger gave you a signal tomorrow, the difference between those two entry points and your ultimate getting out a year and a quarter later is immaterial. But how much you put into that position turns out to be a lot more impactful to how smooth your curve is, what your return to risk ratios are, and all that. So I focused a lot on that at Trendset back in the days. And eventually, now that I've been retired, a couple of years ago, wrote the book, Successful Traders Size Their Positions, Why and How. And those are the exact formulas in that book that I used at Trendstat and I continue to use today as an individual trader. And the thing that's neat about them is you can dial it in wherever you want. If you're a new trader and you want to run, you're 20 years old, you got a lot of money coming in and you want to hit the big time, you can invest 1 or 2% risk of your equity and you will have a wild ride, is particularly in the futures markets. If you're like me and retired and you want to just, take life easy and you're not looking to shoot for 100, 200% returns all the time, well, then I use a half of 1%, for instance. And for volatility, those that like more volatility could dial it in, 0.7 or 1% or whatever you want. And you're willing to let your portfolio go up or down like the wild wind. Me, I'm down at 0.3, something like that. I want to keep a nice, tame, quiet portfolio in retirement. So you can dial it in wherever you want. That's the beauty of the math that I provide in the book. And it makes it pretty easy to see. But I can tell you that from a total return to risk standpoint, clearly position sizing is more mathematically important than where you get in and where you get out.
Yeah, a nice hypothetical fun question for you. If you were given 5 million to manage, which I know you don't anymore because you're retired, but let's just say a hypothetical all-weather trader, a fan of yours, was given 5 million. Would you advise them to leave it in cash and then make trades as the next signals are given, perhaps missing out on being in the middle of a trend? Or would you invest it immediately based on what your signals have already shown and then manage from that point?
That right there is an unbelievably brilliant and insightful question. And I do have an answer because I've studied it.
Oh,
At Trendstat, we ran a research report that, because we got the same question from some of our large institutional clients, if we give you $1 million, what are you going to do with it? And some commodity trading advisors will go in and they'll just take new signals only, and others will just invest it immediately. It turns out that when you run a study of this and then randomize the entry of that, say, $1 million portfolio and whether or not you put it on the equity curve right away. So you go in and market, just here's your portfolio that we have right now. This is what you've got. It turns out it makes more sense to actually put them all in and get on the equity curve, no matter where you are on the equity curve, because what ends up happening if you don't do that is markets that are already trending, you'll miss out on. New signals, if you think about it, and over time, I figured that somewhere in the 33% of the time on new signals, I'm going to be positive. 2/3 of the time, I'm going to be wrong. So by only taking the new signals, I'm slanting the first 3 to 6 months of the portfolio in those issues that have the about a 2/3 chance of being losers.
Oh,
So
geez.
you end up not having the benefit of any of the trends, the full benefit of all the potential losers, and you're hoping that a new winner comes along in that 1/3 of those new trades, and the math just doesn't work out. It's better to just get right on the equity curve and enjoy whatever every client. It's so much easier as a money manager to actually manage everybody that way too. But we actually mathematically proved that it was better to be on the equity curve than to piecemeal yourself in.
Wow,
Good question. Good
fascinating.
question.
Yeah, that's actually from my friend Ron Moore. So Ron, when you're listening, you'll get to realize you asked a great question.
Smart
Lovely,
guy.
lovely gentleman. Yes. He's enjoying being a grandfather to it. Used to be a trader at Merrill. He's now doing other things.
Yeah.
What is the last, bit of wisdom you'd want to impart on the listeners? We try to cover a broad range of topics without, asking you every single question under the sun. As I want them to read the book and not just watch the video.
Um, I guess I would say to most traders, don't think of yourself as a trader. There's this stereotypical um, image of the trader being a high stressed, predicting what the market's going to do next and getting ahead of it and getting through all this angst all the time. And I would prefer every trader or investor out there think of what they're doing with trading as sort of a business. Uh, Ask yourself, if I was going to run a trading business and manage Tom's personal portfolios, what would that business look like? I'd have to have some computers probably, because I'd probably need to be able to have some software running. I'd need to have enough capitalization, need to uh, carve out a certain amount of time each day to do this work. I may have to hire people to help. There'd be this sort of mentality of strategically thinking through what is the financial puzzle that you are trying to solve with this particular portfolio. And instead of worrying about whether XYZ is going to gap open 10%, that mentality of thinking that you're a trader is so much more stressful, so much more up and down and all over the place and hard to deal with. And if you're a businessman or a businesswoman looking at a strategic direction of how am I going to handle this in up markets, down markets, sideways markets, like I suggest in the All Weather Trader book, you find yourself removed from the stress a lot. You find yourself making far more intelligent long-term decisions to manage the risk that you're going to take on, the volatility you're going to take on, the types of markets you're going to trade to make sure they're diversified, how you're going to effectively handle all that and deal with the minutia of actual trades going over, and you have to either log those in or verify that they were done correctly. I mean, you try to make it all manageable by having a plan. I think a lot of traders and investors just don't have any kind of strategic plan.
Yeah,
And
it seems like we're just
you
making it
just
up
look
as
at
we
the
go.
if you look at the Twitter comments, oh my God. I I just am amazed that some people even put those comments on Twitter. You know, a Apple is going to gap open on the more opening. That's what I'm predicting. All right. Well, what does that mean? And why do I care?
Oh boy.
You know?
Yeah. And our mutual friend Tony, who was a mentee of Ed Secotis, would be
Yeah.
rolling his eyes about non-existent futures right now. He would be very annoyed with that prediction. Tom, what's the best way to get a hold of you and to follow you? I know you're on several different platforms.
I guess aside from the website is a great place with a lot of information. Tom Basso, it would be things like interviews I've done and books I recommend and research papers I've done in the past and all that. So that's all in one place. And there's a lot of free stuff there. So you can't argue about the price. There's a few things that you can pay for that help pay for the website, but they're not very expensive. I'm not getting rich off of the website. And so that's enjoytheride.world, not .com, .world. And that's based on the ETR that came up, and I use a lot in my posts. And then the other things, Twitter is probably the place where most people are following me, and that's at Basso_Tom. But you can also find enjoytheride.world on Facebook. You can on LinkedIn. I believe I'm just Tom Basso again. I think just put my name in there, you'll find me. I'm also on MeWe, Getter, but there's hardly anybody on there talking finance, so I wouldn't worry too much about that. Those are kind of the probably the bulk of however everybody follows me and gets my stuff. And I like doing interviews like this because they're a lot of fun for me to reminisce about, I guess, things in my life and hopefully help other people. So if people discover this interview and want to interview me, I'm always happy to talk about that and see if it works in the schedule. When we get to India and places like that, Hawaii is not so bad. You're up at 6 a.m. and I'm at 9 a.m. But you start getting to India, I got to get up about 8 o'clock and they're almost going to bed. So it gets a little harder when you get far away time zones. But I have fun with the interviews, and we have fun with life and with trading and engaging in social media. So it's good life.
All right. Well, thank you again so much for your generous um, offer of time and answering, all these questions and for giving back to the community, Tom. I know you have plenty of fun activities you could be doing, like golfing, and I know you enjoy your jogging. So thank you again, and mostly, congratulations on being a grandfather. I can only imagine that must be very exciting.
Yeah, that's fun.
All right. Thanks so much, Tom.
Thank you, Andrew.
Thank you.